We think of risk as the likelihood of us losing a portion of our invested capital in a business permanently. If we invest, say, at 10 now and a month later it's at 8, that isn't permanent. It's an opportunity to buy more of the same, and if your portfolio balance allows it, you would go ahead and do that. Permanent loss of capital over the long term usually arises if a business underperforms your expectations or if market valuations across companies decline, effectively when the market cycle turns against you. The other aspect of risk that is often ignored and is hugely important, especially in the Indian context, is the time value of money. The cost of equity capital in our country is 12 to 15%. And if we were to go through an investment which for several years doesn't perform, then we have a serious problem of non-performance. Our approach to managing risk is therefore to maintain a twin focus on both getting the business forecast right as well as not paying excessively for it. So how do we manage risk? First of all, we see risk management as an integral part of our investment framework. If we get our due diligence right prior to making the investment, the job is half done. What does our investment framework need us to do? Obviously, business must have a strong competitive advantage. High standards of corporate governance, both in terms of the integrity and the capability of management. Ability to grow the business sustainably at 15% or better, and the ability to do it capital efficiently, earning a return of equity of at least 15% or higher. And to do all of this without using too much of financial leverage, maintaining low quartile leverage relative to its peers. Secondly, then, what is the price we are willing to pay for such a business? Are we willing to say there are other peer companies which are trading at higher multiples and this company is available to us at a lower price multiple and therefore it's cheaper? That's not how we look at it. The way we look at price to value is simply by looking at the price we would have to pay relative to the sustainable earnings growth that this business is capable of generating in the foreseeable future. And the level of capital efficiency with which it's capable of generating that growth. That matters a lot to us because that determines the level of cash flow that this business will generate for shareholders. Thirdly, diversification. There's no substitute for diversification as a way to mitigate portfolio level risk. So we work with a structure of stock limits and sector limits, and these are calibrated to the level of conviction we have on that business and on that sector as a whole. Fourthly, post-investment tracking. There's an analyst who understands that sector, understands that business, and is not looking at more than 7 or 8 businesses. And the time and the experience that he brings to his job on a 24/7 basis with quarterly conference calls and frequent meetings with management, all of that is part of our post-investment tracking process.